See the German economy going this year through a mild recession, but we are fairly confident that Germany would come out of it. Why are we confident? Because the two big drivers for the German economy to slow down are price shock, especially gas price shock, and inflation requiring tightening of monetary conditions. Those are both one-off. They're going to go away. What is more important for Germany is to think about the structure of its economy for the future. Of course, like any other country, structural reforms are a must. In this more uncertain world, with low growth prospects, concentrating on how you can increase productivity and capture the economy of tomorrow rather than being stuck in the economy of yesterday. And of course, for Germany, this is very visible in the need to restructure the automobile sector for this economy of tomorrow.
So interesting there. She's saying that Germany have a need to reform to become an economy of tomorrow rather than being stuck in the economy of yesterday, and of course a heavy reliance on old industries. But what is also interesting about this curtain raiser speech, something that Georgieva raised, is the fact that the US has been a bright spot this year. Remember, it was a year ago we had all of these interviews going on, all these CEOs were coming on our shows and saying we're going to see a recession, we're going to see a recession. It actually hasn't transpired within the US. And I asked the MD why that's not the case and whether the IMF themselves still see a possibility of a recession at some point.
We do not project the recession in our baseline, and actually the most recent developments in the US make soft landing even more likely. What we see is, first, inflation is starting to go down. The actions of the Fed are paying off. Second, consumer demand remains strong, despite the fact that savings that were accumulated during COVID are melting, and labor markets are very tight. What the US is benefiting as well is less dependency on energy imports. So they didn't get the same shock Europe had to suffer when Russia invaded Ukraine.
Many central bankers around the world have started to use the phrasing rates are getting close to or at sufficiently restrictive levels to bring inflation back down to target. Do you think that this fight against inflation is now over? Is it mission accomplished for policymakers and central bankers?
In some countries, yes. Look at Brazil, for example. In the US, the Fed is now thoroughly monitoring to see whether maybe time has come to pause. In some countries, not quite yet. And this is very important to recognize that we have to be data dependent, and countries' standing is diverging even within advanced economies, within emerging markets. Where success has been achieved is mostly because countries stepped up in tightening early and were vigilant. And now the payoff is in their hands. So what is our advice to central banks? First, continue to be vigilant. We cannot afford to lose the fight against inflation because we would undermine consumer and investor confidence and we would affect growth. Second, be data dependent. Third, communicate your intentions clearly.
Well, a list of prescriptions for central bankers there, if only it was that easy. But of course, she has flagged that inflation in some countries has started to move back to target. In the case of Brazil, they've actually started cutting again. So we are evidently close to the end of the cycle. But let me just take you back to one final point, which I think is going to be a major theme of the discussions in Marrakesh next week. And that is this point of geoeconomic fragmentation. It has come up time and time again. Back in April, they had an entire chapter devoted to this particular topic and the fact that trade barriers are going up around the world. There are export restrictions. You see it a lot between the US and China, but it is not just the US and China. It is global. And to that effect, I asked the managing director what sort of impact that could have on global GDP if it continues.
We certainly see a fragmentation throwing cold water on what is, in any case, weak growth prospect. Since 2017, trade restrictions increased 6 times, from 500 to 3,000 today. And when you restrict the flow of goods, inevitably that leads to higher costs. And that translates into price pressures undesirable at the time of high inflation. We would like to see thoughtful approach to what is a reality. We do need to pay attention to resilience of supply chains. Security of supplies has to be factor in economic decisions, as well as because of the climate crisis and the need to shrink our carbon footprint.